Hi. So one of the first things I talk about is bridge and interim financing. It is something that is commonly misunderstood. Those two terms just get kind of mixed up in general. So to help your understanding and to add clarity to what is a kind of a confusing process, I thought I'd help with an explanation. So bridge financing, very specifically, is when your house that you have listed has sold. So that means you have an unconditional offer on it. So somebody has come, put an offer on your home, they've done their inspections and due diligence, whatever is required, and they've lifted their conditions. You may still be living in your house. They have not yet taken possession and not yet provided you funds. So you do not have the proceeds of the sale of your house to put towards the down payment on the new property that you intend on purchasing. So the new property you intend on purchasing, you have no money yet from the sale of your house. And the closing date of the new property is before the date of completion of your existing property. So if your closing date is June 1st for your completion date of your new property, so you intend to move into your new property on June 1st, but your closing date of your sale does not occur until June 15th, you will not have any money for those 2 weeks. So where does that come from? And that comes from the bridge. So bridge financing is generally at a higher interest rate, and sometimes the rate's like almost 10%. It's prime plus a percentage in most cases. Sometimes it has to be registered. So that would mean that it has to have legal fees associated with it, and then it has to be discharged. So there's fees associated with that as well. And in some cases, there's lender fees in addition to like all the other little bits and pieces. So it's really crucial that you make sure that you understand your bridge financing, because between the banks, the credit unions, and the monoline lenders, there's no real transparency when you're looking at comparing the different offerings. And some institutions don't even offer bridge financing. So that's not even an option. You have to get private financing for that short period of time, which most lenders are totally kosher. Like, it's fine, but it's just an expensive option. So it can be a really beautiful, convenient option because it gives you the luxury of not having to move in one day. So what I mean by that is if you are taking possession June 1st and the sellers aren't taking possession of your old house until June 15th, that gives you a 2-week move. So you don't have this rush 1-day transfer where there's boxes and chaos everywhere. So there's a cost to that, and the cost is those increased fees and lender fees and potentially the registration fees as well. So just something to be aware of. Now, interim financing is when maybe you haven't even listed your house yet, or you've listed your house and it hasn't sold, and you found the perfect house and you want to purchase it, and it's so perfect that you are willing to register a more complicated or more expensive financing tool in order to secure that new property, because you will not, in most cases, have the sale proceeds to put towards the down payment. So in that case, we'll secure an interim financing loan for you. Now, in a lot of instances, when clients call us up, it's usually elderly clients. They have established their home over 30 years in some cases. They have lots of stuff or lots of yard equipment, and they don't want the pressure of selling their house and then just willy-nilly trying to find a property to buy. So in those cases, they want to have a long window, and we'll do some interim financing for them. So how that would look is they have listed or they have not listed their property. They found a property that they love. They'll call us, explain the situation. We'll say, why don't you ask for an extended closing date on that purchase of that property? So maybe don't close until September and now it's June. That gives them the opportunity to try to organize if they want and list their house and then try to secure a buyer between now and September. In turn, our office will organize an interim financing loan to ensure that if their house does not sell by September, that we will have a financing arrangement that will protect them and they can utilize for the purchase of the property. Now, it's expensive. it's generally 10% plus fees. And if they haven't listed their house even in September, they have to realize that there's this big cost associated with retaining both properties. The other thing we can sometimes do is we can register a home equity line of credit on their existing property and maybe even on the new property, and they can use the funds from their home equity line of credit to lower the amount of interim financing needed. So say the new home is $1 million and they're planning on selling their home for $2 million, they're downsizing, of course, then rather than having to finance $1 million at 10%, which is very expensive on a monthly basis, we can say, well, we can register a $600,000, this is hypothetical, they have to qualify for this, of course, $600,000 line of credit on your existing property because it's not listed. And then we can take that $600,000 in September when they're taking possession of their new property and use that towards a down payment, which means they only need a $400,000 interim financing loan. This is all readily disclosed to everyone. Everyone is very aware that this is going to happen. So when I say everyone, I mean the lenders, and the clients understand that by borrowing the funds from their existing residence, it will inevitably get paid off when that residence sells. They will have a lower requirement for that interim financing at such a high rate to lower their overall expenses. It does get registered, of course, that home equity line of credit, so there is a cost to that. But of course, it's just numbers. We work those out. We kind of show you what the best path is to move forward. But interim financing is when your house has not sold, whether it's listed or not. We're looking at those solutions, and it really only works when you have a house that has a lot of equity in it compared to the value. So if you have a $300,000 mortgage, your house is worth $700,000, then you have $400,000. We can generally only on an interim financing loan between the two properties go up to about 75% of the value of both, depending on the financing required. So it can be a bit of a juggle. But of course, again, numbers, that's our specialty. We'll help you work through that. So if you have any questions about interim financing or bridge financing, please reach out to us. We are happy to accommodate. Thank you.